How to invest in index funds. Investing in index funds is one of the most effective ways to grow wealth over time, especially for individuals who want to balance risk and return while avoiding the complexities of stock picking. Index funds have gained tremendous popularity over the past few decades, and their appeal continues to grow. The idea behind them is simple. They aim to replicate the performance of a specific market index, such as the S&P 500 or the Nasdaq. However, there's more to it than meets the eye. Here are two interesting facts to start. First, according to a study by S&P Dow Jones Indices, over a 15-year period, 92% of large-cap active fund managers underperformed the S&P 500. That's a striking revelation when you consider that people often trust active managers to beat the market. Second, Warren Buffett, one of the most successful investors in history, has repeatedly recommended index funds to everyday investors, even making a bet in 2008 that an index fund would outperform a group of hedge funds over a decade. P1. How index funds work. Index funds are designed to match the performance of a specific index. This means that instead of actively trying to buy and sell stocks to outperform the market, an index fund manager simply buys all or a representative sample of the stocks or bonds in a given index. For example, an S&P 500 index fund will include all 500 companies that are part of the S&P 500 index. The idea is to mirror the market, not to beat it. As a result, index funds are considered passive investments because they don't involve the constant buying and selling that active management requires. The attraction of index funds lies in their simplicity and efficiency. Because these funds aim to mimic an index, they tend to have lower expense ratios compared to actively managed funds. Investors are charged less because fewer resources are needed to run the fund. The cost advantage is particularly significant over the long term, as it can add up to thousands or even tens of thousands of dollars in savings due to compound interest. In contrast, active management fees are higher because fund managers claim to provide expertise and strategies to outperform the market. But, as mentioned earlier, most of them don't succeed in doing so over the long haul. Why index funds have gained popularity? Index funds are gaining in popularity for several reasons. One of the key reasons is the efficient market hypothesis, EMH. The EMH posits that stock prices always reflect all available information. Therefore, it is nearly impossible to consistently outperform the market over time because any new information is quickly reflected in stock prices. If markets are efficient, as many economists believe, then passive investing through index funds is a sensible approach. Trying to pick individual stocks or time the market becomes a futile exercise. Another reason for their rise is the increasingly globalized economy. Index funds are an easy way to gain exposure to a broad market, sector, or geographic region. This diversification is crucial because it reduces the risk that comes with investing in a single company or industry. Index funds spread your investment across hundreds or even thousands of different stocks, making them less volatile compared to individual stock investments. Moreover, index funds are tax efficient. Since the fund manager isn't actively buying and selling stocks in an attempt to beat the market, the fund realizes fewer capital gains. This translates to lower taxes for investors, making index funds more attractive, especially in taxable accounts. Advantages of index funds. The first major advantage is low cost. Most index funds have expense ratios as low as 0.05% to 0.2% compared to 1 to 2% or more for actively managed funds. Lower costs mean that a greater portion of the investor's money remains in the account, compounding over time. The second advantage is simplicity. With an index fund, you don't need to spend time researching individual stocks, reading annual reports, or following market trends. You can essentially set it and forget it. Since the fund mirrors a broad index, you can rest assured that you're getting exposure to a wide range of stocks or bonds. Another advantage is predictability. Index funds aim to match market performance, so their returns are relatively predictable over time. While the market fluctuates in the short term, it generally trends upward in the long term. Historically, the S&P 500 has returned an average of about 10% annually over the past century, although returns vary from year to year. Diversification is another key benefit. Since most index funds hold hundreds or even thousands of stocks or bonds, they automatically diversify your portfolio. This reduces the risk associated with investing in individual securities. If one company underperforms, its effect on the overall fund is minimal. Disadvantages of index funds. However, index funds are not without their disadvantages. One of the most glaring drawbacks is that index funds are not designed to beat the market. They simply aim to replicate the performance of the index they track. Therefore, if you are looking for extraordinary returns, you won't find them in index funds. Another downside is market risk. Because index funds track the entire market or a sector, they rise and fall with the overall market. In a bear market or recession, index funds will likely see significant losses. Unlike actively managed funds, which can shift to cash or defensive sectors during downturns, index funds are stuck holding their positions. Additionally, index funds lack flexibility. Active managers can make tactical decisions, such as avoiding overpriced stocks or focusing on undervalued ones, while index funds are rigidly tied to the composition of the index. If a stock is included in the index, the fund must hold it, regardless of whether it's overvalued or underperforming. Furthermore, there's the risk of over-diversification. With some broad index funds, you can end up holding thousands of stocks, many of which may not contribute much to your overall return. In essence, your returns are diluted because you own too many companies, both good and bad. Choosing the right index fund. When deciding to invest in index funds, it is crucial to choose the right one for your needs. Not all index funds are created equal. Some track broad market indices like the S&P 500 or the Wilshire 5000, while others track more specific indices, such as those focused on technology or international markets. It's essential to align your investment goals with the type of index fund you choose. For example, if you are looking for global exposure, you might choose a fund that tracks the MSCI World Index. If you prefer to invest in specific sectors, you could opt for a sector-specific index fund. You should also consider the fund's expense ratio. Even though most index funds have low fees, some are cheaper than others. Vanguard, Fidelity, and Schwab are known for offering low-cost index funds with expense ratios below 0.1%. Over time, lower costs can significantly boost your returns. Lastly, it's essential to consider tax implications. While index funds are generally tax efficient, they can still generate capital gains distributions, especially if they're not in a tax-advantaged account like an IRA or 401k. If you're investing in a taxable account, it may make sense to choose a tax-managed index fund that seeks to minimize taxable distributions. In conclusion, index funds offer a simple, low-cost, and efficient way to invest in the stock market. They allow investors to capture broad market returns with minimal effort and at a fraction of the cost of actively managed funds. However, they are not a perfect solution. They do not outperform the market, they lack flexibility, and they expose you to market downturns. For many investors, though, the benefits far outweigh the drawbacks, making index funds a core holding in a long-term investment portfolio. By choosing the right index fund, managing costs, and being mindful of tax implications, investors can build wealth steadily over time without the need to constantly monitor and adjust their portfolios.